What's up, everybody? Monday, September 23rd. I was out in California over the weekend in Los Angeles and had a good time. It is Monday, as I said, which means I sent out my new edition of MMT Trader. It is out. If you want to get a copy of that, go to my website, pitbulleconomics.com, sign up for a 30-day free trial. So I want to talk a little bit today about what is going on with the Fed and the repo situation. Now, you know, everybody is talking about this as some major calamity, as doomsday, funding crisis, all this stuff. I want to kind of put this in perspective, but I will say right at the outset, I will say that these actions by the Fed are short-term disruptive. They are short-term disruptive, and if this were not happening, and this goes back, and I'll get into it, this goes back to what I believe to be a case of very bad mismanagement on the part of the Treasury, U.S. Treasury. And that goes back to the debt ceiling again. It's been a recurring thing that I've been talking about. Hey, by the way, just let me mention as an aside, you see the economic data much stronger than everybody thought. Suddenly the recession outlook is fading away very quickly. Now, who told you that? I told you that. But that is something that, you know, I've been telling you for a long time. I'm not going to talk about that on this video. I am going to talk about this overnight funding and the repo situation. So this all goes back again to the Treasury. Now, if you remember, it all goes back again to the debt ceiling. If you remember, the Fed was bringing down reserves at the time when we hit the debt ceiling, which was mid-March. Actually, the Fed started to bring reserve levels down. This goes all the way back to December 2017, but they've been coming down. At the beginning of March, we had about 1.7 trillion of reserve balances, and then we hit the debt ceiling. And of course, the debt ceiling, what did that do? The debt ceiling made it impossible for the Treasury to issue new debt, Treasury, agency securities, etc. So those treasuries, those bonds, which are the highest rated collateral, tier 1 assets, banks need them. No new treasuries were being issued, but at the same time, the Fed was bringing down reserve balances. In the period from when we hit the debt ceiling in March until finally when they suspended the debt ceiling at the end of July, reserve balances came down by over 200 billion. They basically went from 1.7 trillion to 1.5 trillion. Big drop in reserve assets, and those are assets that the banks not only need, but they are required to hold. Either that or some other tier 1 reserve alternative like Treasury securities, which the Treasury was not issuing. So, and here's what happened. When they finally lifted the debt ceiling, the Treasury, for some reason, instead of trying to get back where it should be in terms of putting those securities back into the financial system by selling them again, because now it had the green light to go ahead and sell the bonds, it kind of took its slow time. If you look at the Treasury's balance at the Fed, it hovered around 130 billion for most of the month of August, the entire month, when the target level for that balance was 350 billion. They held it down around 130 billion. So they waited and they waited and they waited. In the meantime, bank assets went way up, over $300 billion in that period of time from March until when they suspended the debt ceiling. So the banks needed reserves, right? And then what happened? They needed reserves, or either reserve equivalents like bonds. Then what happened? You come into September and bam! They start issuing new bonds. They start selling bonds, what are bond sales. Reserve drain, right? So that drains reserves even more. And then double bam, you get hit with a big September corporate tax payment. Drains reserves even more. So now the whole system is short reserves. See what I'm saying? The Fed was bringing reserves down all through the period of the debt ceiling. The Treasury wasn't selling any Treasury bonds, which are reserve equivalents, all right? Risk-free Tier 1 assets, which the banks needed because they were increasing their assets at the same time. Then they lifted the debt ceiling, and what did the Treasury do? Nothing. It sat on its hands, okay? It kept its balance at the Fed around 130 billion when it should have been 350 billion. Then it hit September, and boom, they start selling Treasuries. More reserve drain, and then boom, again, you get the tax payment in mid-September, and the whole system gets caught short reserves. That's why the banks had to bid up, and it went over 10%. So the Fed steps in. So okay, what's happening now? It is, it is rectifying this situation. Okay, you can't have the system short. They need that stuff. So the Fed steps in now to rectify this situation, but all of a sudden it's like they're dumping and they're dumping and they're dumping. So that what happens then, that affects their leverage ratios. What is the supplementary leverage ratio? It is bank capital, Tier 1 capital over consolidated assets. All right? So consolidated assets is that denominator. When that goes up, when they're dumping more reserves in there, that number shrinks, okay? When the denominator gets bigger, right, and the numerator stays equal, that number gets smaller, but it has to be at least 3%, and actually, it's really up around 10%. So this is the problem. Now they're dumping in all these reserves through these repos, and what does that do? It doesn't allow the banks, at least immediately, to increase risk assets. They have to kind of digest all of this. So we have this kind of stall in the market. We could have even a soft patch in the economy as a result of this. Are you following all this? Folks, this is about understanding. This is about information. You know, I was thinking about something over the weekend. And I was thinking about the fact that so many of you, you overvalue money. And what am I talking about when I say that? You put such a high value on money that it keeps you from doing the things and behaving in ways that is going to actually bring you the money or the results that you are seeking. All right? That is the irony of it. You overvalue money. What do I mean when I say you overvalue money? You are so afraid to part with money. And there's only one reason for that. And when I say part with money, that could mean, let's say, paying for a service like mine. It could mean pulling the trigger on a trade or an investment. It may mean staying with a trade or an investment for a period of time until it reaches its end goal. Because you are afraid that might go away, or it's not, you don't have it in your hand right now, so it triggers some fear inside of you. And there is only one reason why all of you are afraid or you overvalue money, and that keeps you from achieving your goals. It's because you don't know how to go out and get more money. Think about it. The amount of money out there is limitless, infinite. There's an infinite amount of money out there. But most of you, you hang on, you cling to that little money. It could be $100 a month or $250 a month. Oh, Mike, I can't do it right now. I'm in a financial condition. I lost my job. It has nothing to do with that. Nothing to do with that. There is an unlimited amount of money out there. The problem is, in your mind, you're blocked. You have overvalued money to such an extent, and at the same time, you don't know that causes you, number one, not to part with it, which could mean pulling the trigger on a trade. It could mean signing up for a service that is going to benefit you, and the reason is because when you part with it, you don't know how to go out there and get more. And the abundance of money is infinite. Infinite. Now, some people are really, really good at getting it. Some people a little bit less, but the point is, it is out there for you, for everybody. Everyone can get it, but you, because you don't know how to get more. And it's a teachable thing. Whether it's in trading, whether it's in your business, whatever it is you do, whether it is in your job or your career, it is a teachable thing. But you have paralyzed yourself with this concept of money above all else, and that keeps you from getting the money and the level, putting you at the level where you want to be. Think about it. That's what it's all about, folks. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader or Zombie Trader. And by the way, in my life personally, every single time I overextended myself, like way overextended myself, I ended up far surpassing what had been prior to that point like a scary point for me. Think about it.